Here's a mortgage rule hack most first-time buyers never hear about, and it can cost you tens of thousands of dollars. In Canada, you can buy the home you live in with as little as 5% down. But the moment you want a rental property, the rules change. And you will need a minimum of 20% down, which could be as high as 35% down, depending on the lender and whether it's a single-family home or a condo. I'm Murray with the Zelinski Realtor Group. I'm licensed as a real estate agent and a mortgage associate, simplifying the real estate and mortgage process for you. If you would like to know how this mortgage hack might work for you specifically, message me with hack and I'll connect with you further. Before we dive into things, I'm going to take you back to 2000 and give you a little backdrop into my scenario, which was before I got into the real estate business. Back then, my wife and I had bought our first home. We had our first child. We were working on our long-term financial future. And some very successful people I really respected, along with my mentors at the time, all had one thing in common. They all had rental properties and real estate as part of their wealth building strategies. Now, this video is not a deep dive into the pros and cons of owning real estate as an investment. We'll save that topic for another video. But back then, we were able to buy rental properties for 5 to 10% down payment, which were also insured rates. And we'll talk a little bit about insured rates further too. But it all changed shortly thereafter. So today, not only do you require a minimum of 20% down, the rates are also considered uninsured. Basically, if you're buying your home, there is a mortgage default insurance premium built into the mortgage, which allows for a down payment for as little as 5% down, and also the best mortgage interest rates a lender can offer. The reason? The lender is covered if you default on your mortgage and they have to foreclose. Now, when it comes to investment property, there is no default insurance payment or premium. So the lenders require more down payment for security, and they charge a higher interest rate. Seems strange, right? The more money you put down and there's a higher interest rate. So here's the question I get asked all the time. Is there a workaround or a way around that scenario? Well, there actually is. And it comes down to one thing: the order you buy your properties. Today, I'm running two real scenarios. Same two properties, same buyer, same rates. The only thing that's going to change is which one they buy first. The difference is big. It's over $50,000 in cash you don't have to come up with, and you can save. Let's look at that more closely. Scenario one, you buy the dream home first. This is the traditional path most buyers take. You buy the home you actually want to live in first, then a couple years later, you decide to add a rental property. Let's say the first home you buy is $500,000, which is an average price in Stony, Spruce, West Edmonton area today. Your minimum down payment is 5%. That's $25,000 from that savings bank account of yours. Since it's under 20% down, this is an insured mortgage, and this will add a default insurance premium on top. In this case, that's 4% of the net loan. That's after your down payment against the purchase price, which now adds an additional $19,000. That gets rolled into your mortgage, so your total mortgage is now $490,000 at a 5-year fixed insured rate of 4.19%. And because this is a first-time buyer purchase, you qualify for the newer 30-year amortization. Your payment works out to $2,412 a month. A year or two later, you want to expand your long-term retirement investment and decide to invest into a rental property. That's, let's say, it's about $350,000. But now the down payment jumps to 20% because it's not the home you live in. That's $70,000 in cash that you need to come up with on your own. Not gifted funds allowed from mom and dad either, like you can do for a home purchase. Since there is no mortgage insurance available on a rental, you're now financing $285,000, and the maximum amortization on an uninsured investment property is 25 years. Remember, if it's a home as a first-time buyer, you can qualify for 30 years, but not on an investment property. At current uninsured rate of 5.54%, makes your payment $1,726 a month. Added up to own both properties, in scenario one, you need $95,000 in combined down payment. Further, your combined monthly mortgage payment is $4,139. Now, let's look at scenario two, where you buy your future rental first. When I meet with young home buyers, the discussion generally leads to investment properties and a desire maybe to own one in the future. When this comes up, I recommend this reverse strategy. Buy the future rental first. Now let's look into this a little further. Same buyer, same two homes, same rates. The only change is the order. This time you buy the $350 home first, the one that will eventually become your rental. But right now, it's simply your very first home. You buy this with 5% down, that's $17,500, same 4.19 insured rate, but you can also get the 30-year amortization because it's your first home. Your total mortgage is $345,800 after the default mortgage insurance premium, and your payment is $1,689 a month. A few years later, your family is growing and you're ready to move up and into your $500,000 home, the one you actually want to live in long term. Here's the part people miss. You can still buy this one with 5% down with the lower insured mortgage rates, and you can still qualify for a 30-year amortization, either because it's a new build or your first purchase was long enough ago that you re-qualify under the first-time buyer program. $25,000 down, $494,000 mortgage, 4.19 interest, working with a 30-year amortization. That payment is $2,412 a month. Now you move into home number two, and home number one, the one you already own with an existing insured mortgage, comes your rental. You didn't apply for a new insured mortgage on a rental property because you can't. Insurers won't issue one. You simply change how you use a property that was already insured back when you bought it to live in. Adding it up, total combined down payment for both properties in scenario two is $42,500. Combined monthly mortgage payment is $4,100. Now, let's compare the total dollars involved between the two scenarios. Same two homes, same buyer, same interest rates. Scenario one, buy the dream home first, costs $95,000 in combined down payments. Scenario two, buy the future rental first, which costs $42,500. That is $52,500 less cash you need to save up and bring to closing just by changing the order that you purchase. And here's the part that surprises people. Your combined monthly mortgage payment is not higher in scenario two. It's actually about $37 a month lower because both properties get the 30-year insured amortization instead of one of them being at 25 years and uninsured rates. This also makes a difference in the cash flow of the investment now too. Okay, my caveat here though, or what some of you may be thinking is, Murray, a few years down the road, my home will be higher in price. I agree, that may very well be the case, but so is the rental property if you use scenario one. Either way, this reverse buy scenario will always save you more money using option two than option one. Now, I'll be straight with you. This isn't free money. In scenario two, you are financing more total debt overall because both mortgages carry a default premium instead of just one. And your equity position starts out thinner on each property. What you're trading for, however, is a slower equity build for a dramatically lower cash to close position. For a lot of first-time buyers, that trade is the difference between getting into real estate investing in your 20s and 30s versus waiting until you're in your 40s or older to save up a 20% down payment. Now, the CRA side of the equation is this. Here's some things that trip people up, and it's the part that makes this whole strategy legitimate instead of a loophole. When you stop living in a home and start renting it out, CRA treats that as what's called a change in use. Under the Income Tax Act, you're deemed to have sold a property at fair market value and immediately bought it back, even though no sale actually happened. If the property has gone up in value, that can trigger a capital gain in the year you make the switch. The fix is in subsection 45-2 election. You file it with your tax return for the year you start renting the property out, and let's say you defer that deemed sale until you actually sell the property down the road. As a bonus, it also lets that home continue to qualify as your principal residence for up to 4 more years while it's tenanted, even though you're not living there anymore. The trade-off is you can't claim the capital cost allowance, that's the depreciation on the property while the election is in place. This isn't a gray area or workaround, it's a documented CRA election that's been on the books for decades, specifically for buyers doing exactly what we just walked through. However, my disclosure is this. I'm not a tax accountant, and I'm not here giving any advice on taxation and accounting practices. Always talk to your accountant about your tax position and how to declare any changes in your real estate portfolio. Now let's look at the cash flow win. There's one more piece worth the analysis and discussion. In scenario 2, the day you move out of home number 1 and into home number 2, home number 1 already has a mortgage payment of $1,689 a month. And now it has a tenant paying rent against that payment instead of you. Even if the net cash flow was minimal, you have the tenant paying down your mortgage balance month after month, year after year. Not to mention any gain in market value appreciation of the home as well. As a side note, check out my other video where we take a deep dive into assessing and analyzing a rental property from an investment perspective. The real pros and cons of being an investor and a landlord, and I can share many stories with you. So in summary, if you know you want to invest in real estate eventually, but you're buying your first home right now, the order you buy in matters more almost than anything else in this conversation. Buy the property that makes the most sense as a future rental first, live in it, then move up to the home you actually want. And let the first one become your rental with the insured mortgage and longer amortization already in place. If you're a first-time buyer in Spruce Grove, Stony, or West Edmonton market, and you know rental properties are part of the long-term plan, this is a conversation worth having before you buy home number 1. Not after. If you want to run your own numbers with me and see how things look to you specifically, reach out and I'll walk you through exactly what you would qualify for on both properties. And remember, if you like this video, subscribe for more of these breakdowns and I'll see you in the next one. I'm Murray with the Zelinski Realtor Group, simplifying the real estate and mortgage process just for you. Cheers.